Mr. King, will you call the roll for us, please?
Yes, sir. Good morning.
Good morning, Lamont.
For the State Treasurer, Mr. Moore. Here. For the Director of Finance, Ms. Ortega. Here. Ms. Higa.
Here.
Ms. Hendricks.
Here.
Ms. Dillon.
Here.
Mr. Rosensteel.
Here.
Mr. Unterman.
Here.
And for the State Controller, Mr. McGuire.
Here.
Mr. Keel, you have a quorum?
Thank you, Mr. King. Number one on the item, on our agenda is the approval of the board agenda and work plan. I'd entertain a motion for approval.
So moved. Second.
It was moved by Ms. Dillon, seconded by Ms. Hendricks. All those in favor?
Aye.
Opposed? Okay, it's passed. Just in terms of looking at the day, as you can see, we're going into closed session. And in closed session, items 2, 3, and 4, items 2 and 3 we'll be doing in the board caucus room with our consultants. We'll be doing those evaluations. And then we'll come back into the main boardroom for closed session items 4 through 5. And we have about 30 minutes allocated for each evaluation. So it gives us a little sense of our time. I'm sorry, I was reading that incorrectly. Items 2, 3, 4, and 5 will be done in closed session. Those are the evaluations. Items 6, 7, and 8 will come back into the boardroom for closed session. And then the rest of the afternoon will be in open session until the end of the day, where we'll have another closed session. But most of our work this afternoon is information item and policy reading. So there's not a lot of actions that we'll be taking. So if we stay on task, we should be okay relative to time. And I know people have flights and the weather's not great, so we really want to be sensitive to managing this day as efficiently as we can. Okay? So with that, we'll adjourn from open session and we'll go into closed session for the evaluations. And Nancy is going to join us, and Ian in closed session. Coming out of closed session, we have some information to report. Chris, I don't know if you wanted me to, I'll just report it now. In closed session, the investment committee is directing staff that as it relates to our decision to have 2 consultants that we made in December, the investment committee would like for a lead consultant to be clearly identified, and that there be a secondary or co-consultant whose responsibilities would include 2 research projects annually and a review of the asset allocation commitment at a minimum on a semi-annual basis. That would be for the co or secondary consultant. Those are the actions taken. Okay? And there were,
That was not action, that's just instruction to staff.
Right.
it's information.
Thank you.
Yeah, just information. Okay, so that brings us back. Chris, your open session CIO report?
Thanks. Wait for Loretta to take a seat. The portfolio at July 31 was 176 billion. You're obviously aware that the markets declined right after January 1 and a few days after, but we're right back to 175 billion. So it has been an up and down market. You can see the end of January estimated asset allocation, and then also the graph. I always try and black or darken out the month of June so everybody can kind of see visually where we are from June. The one thing I know with the funding, people are trying to figure out our return year to date and all of that. everybody has to keep in mind, we have a negative cash flow of $500 million a month, so $6 billion a year. So the fund, if you think about June 30, if the fund ended the year at 157, we'd actually still be breaking even though it looks like the fund shrunk. That was all just negative cash flow. So I just always want to caution people from jumping ahead. This was a picture I borrowed from J.P. Morgan. I thought it really put last year in a snapshot. So I know there's a lot of information on that chart, but basically it is a picture of the race car being the markets. And the headline was that the markets have gotten ahead of themselves. The returns on the car show the 3-year or the 2-year returns for the markets. And then behind it on the hill are the economies. And they tried to be very clever. The USA is the best economy. That's supposed to be the Federal Reserve riding alongside on a moped, putting gasoline in the car all the time. China is the big giant cement truck, and it's actually cracking the road. And then you have the emerging markets. Japan is a wild, exotic race car because the Abenomics, in everybody's view, is still an unknown experiment. And then sadly, the Eurozone is in the back. You can't quite see it, but it is a car, a bike, I think a hang glider and a plane all wrapped in one to try and signify how weird the Euro is. And the bird, which I know the public can't see, but there's a bird at the top, which is an albatross, and it has the sign of the Euro on it. Very clever, but I think it does, in a nutshell, what we're saying is, last year I think the markets got ahead of themselves. The economies need to pick up. Doesn't mean that this year will be a negative year, but it means that, we wouldn't expect the markets to do the kind of returns they've had, which is the thing we've been saying. So here's 2013. The market rose 33% during the year, just remarkable. You can see we had a few downturns in between, but generally a very positive trend all the way up through the year. And especially look at the November, December area where we already thought the market was up pretty strong when it was up 25, and then suddenly it just took another pop at the end of the year. There wasn't a lot of economic news at the end of the year. There was just a lot of optimism, and I think that's what we're seeing in January is some of that optimistic steam come off. Here are the preliminary returns for the asset classes for 2013. So this is calendar year. PCA will be presenting this at the April meeting. So this is just a quick snapshot for you of it. I think, the fund obviously returned at 19.1 gross. It was about 18.8 net. Absolutely stellar results. I have asked State Street to double check that twice, and it is accurate. We dramatically outperformed almost every peer group and every fund I have seen, so it's pretty remarkable. But I think it had a lot to do with the fact that, and the staff behind me gets the credit, we put the weighting in the equity market in the U.S. and we kept it there. We didn't overweight it, so you could criticize us for not being more aggressive. But remember, we started the year with the fiscal cliff. The government shut down for 2 weeks. My joke all the time is, market shut down for 2 weeks, or the U.S. economy shut down for 2 weeks and the market went up 33%. Can you imagine what would happen if it had shut down for 4 weeks? So the thing I'm the most excited about is when you look at that calendar year performance, 5 out of the 6 asset classes have outperformed their benchmark. Absolute return, which is almost nothing there. Turns out now it didn't, now that we have its benchmark in. But I'd highlight actually fixed income out of the group because this is about the 5th year in a row where fixed income has consistently outperformed its benchmark. While it had a negative return, it's a case of outperformance because it only dropped 0.5%, whereas its universe dropped 1.6%. So kudos to the fixed income team. Also, the other team I gave a shout out to on our staff was that real estate has finally turned the corner. As you can see on a 1-year return, real estate is beating its benchmark. So that's been a lot of hard work for that staff, and it's solid. Lastly, I'll also point out that U.S. and non-U.S. equity, even though we only look at it as global equity, we have generally had one or the other part beat the market. This time, both U.S. and non-U.S. equity outperformed their benchmarks. So overall for us, it was a very good 2013, a very good year, and a lot of hard work from staff. And the return relative to peers is going to show that. Here's a quick snapshot of the returns. Now, this is a look at June 30 to January 31, so a 7-month period of time, taking into account the weak January. U.S. is still up about 13%. The best place in the world is really Germany, oddly enough, but still positive numbers even for fixed income around the world. So that's the good news, even with this sell-off. We would expect, as we're seeing, fixed income to be low to negative returns for the next couple of years. But still some very solid returns out of the major markets for us. So I know one of the questions we'll get is, what have you done for us lately? This is a graph of the market from June 30 to now. And so what you can see is the sell-off we have had in January and here in early February. The market's down about 4, even today, I guess now it's even less, probably about 2.5% fiscal year, or calendar year to date in 2014. But really that just puts us back to where the market was in October and November. So while Wall Street will, and the headlines will always talk about big market sell-off, you have to go back and just kind of reassess, okay, we basically gave up those outsized gains in late December, which we kind of questioned anyway. So we think the market's in a trending range. This was an interesting chart I am borrowing from Dave Wilson, who wrote the book, The Visual Guide to Wall Street, and he works at Bloomberg. He does a chart of the day. This is EBITDA earnings, or what they call operating margin real earnings out of the S&P 500. And when you look at last year, earnings actually waffled. It was really, as you know, the companies made profits through cutting, through depreciation, through a number of different tools, not growing their company. And yet, look at that. Real earnings declined, yet the markets rallied. What everybody's positive about is in 2014, it looks like the earnings are improving again. So the question is, what's going to drive it going forward? Companies really do actually have to grow themselves, hire people, expand plants, acquire other companies. You're not going to get to prosperity through cutting. And so that'll be a key focus for everybody is where's the operational margins go. This is, we talked about this earlier today, this is the asset allocation chart. The red line is the top of the range, the blue line is the bottom. The yellow is the target, and the little blue dot is where we're at. So you can see we are within policy in every asset class and really actually very tight to our asset allocation. We are not taking a lot of risk. We're a little low in fixed income, a little high in global equity, as we have described. That's where we like to be positioned. And I would say we held that very similar chart all through the year. So it's the asset allocation that really drove the great return last year. Yeah.
Can I just ask you on that last slide? I think I pushed it.
I'm sorry.
Oh, that's okay. When you say that's how we like it, when you said you like to be kind of, are you referring to you like to be a little high in global equity and a little?
Yeah,
When you
sorry.
say that, and
From
can you
the
just-
from the house view, as I showed you earlier, that we're very comfortable with where the asset allocation is, and it's very intentional. Probably is a good way to put it.
But are
We're where we want to be.
Were you specifically, though, talking about global equity and fixed income, or are you just talking about across the board?
Global equity and fixed income. Real estate and private equity is because there's such long-term investments. You can't move them up and down. You can't use futures. There's no way. As I was describing, it's almost like a 4-year pipe. What we do now will show up in 2018. And so we just have to kind of watch those where they're at. There are some public market equivalents. We're looking at whether we would use those, but you can't decide to overweight private equity today and make it happen. It really is, the ones we can control are cash, overlay, inflation sensitive, and global equity and fixed income.
Chris, on the slide prior to that, you made a comment about corporate, where will drive us from here going forward. Where are corporate profits historically and cash that corporations have on their books from a historical perspective? Because as you said, we can't cut our way to growth. And so
Yeah, the earnings are actually at an all-time record, which is why the equity market is where it's at. The S&P 500 earnings, I'm trying to squint, I'm going to say that's $14, I think, a share. by the basis of the chart, is actually an all-time record for the S&P 500 operating companies. Yet companies are sitting on, many of them, particularly the tech companies, huge amounts of cash. So I know I speculated on the radio December that this may be a year where we start to see a lot more M&A activity, that either companies, CEOs are willing to put that money to work by expanding their plants, and that was part of the economic summary I gave you today, was a forecast that capital equipment might rise in this year. So they either have to grow the plants, hire people, or they're going to acquire other companies and try and grow through acquisition. So we'll have to see. Obviously, it's a slow economy. CEOs are very reluctant to put that money to work, but some of the risks, which I was going to show you, the risks we saw in October, quite a few of them have been eliminated. So now it's really just pessimism versus optimism. So as I was saying on this chart, this is the one I showed you in November, which was I was looking ahead at, gee, what are the key events that we have to worry about? And my highlight is that almost all of them have been eliminated. There really only are two left, which is S&P 500 earnings. We're at the tail end. That starts in January. Almost all the tech companies are reporting this week, so we're getting at the tail end. Earnings weren't bad, but they weren't really good, and yet the market sold off. Then we still have the debt ceiling limit. What my staff told me today was that that's now, Secretary Lew has said that might be till, what, February 27, so it's not this coming Friday. We have a little bit more time. But the federal government does have to deal with that, and that's been a problem in the past, so hopefully it would be dealt with. But a lot of the fears in the market have been resolved. So you always ask me to go up the crow's nest and look out in the future. I moved internet hacking and disruptions to the top, and just happened to company logo picked up there. I don't know. And I moved up climate change because some places have had droughts, although you wouldn't believe that today, I guess, huh? So the fears in the market are still there, but the positives still remain. We think that while you saw some volatility in the market, we don't believe that you're going to see a sell-off. We think the economy is going to continue to muddle along and grow at 2 to 3%, which is not bad. Last year's 33% return is an outsized return for a slow growth economy. So we'll have to see. And then lastly, the issue is going to be interest rates. We think they're still going to be low through 14. Some people are even speculating 16. That's what's going to drive our returns. Two things I want to highlight for the public at the board to ease the burden of their packet. We are now moving some of the annual reports the board gets. Instead of putting it in the agenda, we're moving it directly to the web. So the state lands report and the home loan report are on annual reports the board gets. Those are on the web and available. They're under the investments tab. For the board's sake, in my CIO report, I included hyperlinks to both of those. So that way you can see them electronically, but they don't add to the page count. And then lastly, I wanted to update everybody on a couple of key personnel issues. Normally we do this in closed session, but this is, I think, good information we could share on the public. I am thrilled to say that California HR and a state personnel board has finally approved our deputy CIO position. You set the salary last March and approved it. We've been waiting, and thankfully yesterday they finally approved it. So we're going to begin the recruitment for a deputy CIO right away. And obviously we know we have some very highly qualified candidates. The other was, we don't celebrate retirements much because I can't get the staff to come in the room and visit with you. They're so shy. But Richard Brose, one of our portfolio managers, retired. And the reason it was significant to us is Richard was one of the original 7 employees hired by this board in 1984. The first 7 investment officers were actually all contractors. Richard was one of those. He retired after, what, Margo, 30? We lost track. Close to 30 years of state service. And just, you'll remember him because he's in private equity, and he really is the father of our credit enhancement program. Ran it from its inception, wrote the policy, and just did a great job. It was a tearful goodbye, but just an awesome person. Wish him the best. And then lastly, the Director of Global Equity. We're doing a search for that right now. We put an ad out in Pension and Investments, so a shout out since the reporter is in the room. That's what it looked like. I just want to thank you. You guys adjusted the salaries so that we match the ranges of CalPERS. We're offering the minimum of the range. But I have seen a demonstrable shift in the quality of the people applying for the job. We have 16 core candidates. 9 of those are already Director of Global Equity at other institutions, endowments, family offices, and a couple of funds, corporate and private, public. And then 3 of those are actually either CIOs or deputy CIOs at other funds. So, you know, we are being able to pull the senior people away from other funds, and it's pretty darn exciting. So thank you for that. And we're at the long list stage, and then we'll work on developing down to a short list and posting the exam, and then hopefully getting somebody in-house, certainly by early spring. That's it, unless there are any questions.
Thanks, Chris. Any
Thanks, Chris.
questions or comments? Okay, seeing none. Items number 10 and 11 are consent items. Does anyone want to pull either one of those items? If not, I'd entertain a motion to approve those consent items, 10 and 11.
Move approval.
Second.
Moved by Ms. Dillon, second by Mr. Utterman to approve. All those in favor say aye.
Aye.
Opposed? Thank you. Item number 12, Diversity in the Management of Investments, 2014, a progress report. This is an action item, and Ms. Solange Brooks.
Yeah, well, Solange
Come on up.
The reason it's an action item is this is a report that goes to the legislature. We did a DMI report last year, but we kept it. It wasn't required to go. This year, it is required to go to the legislature. So with that, I will turn over to Solange.
Chairman, members, thank you very much.
Hit your button.
There, okay, thank you. As Christopher mentioned, this is the progress report that has been submitted to you for approval. It will be distributed to the legislature to let them know what progress we have done in the various initiatives we had. The one very important point that I want to make is that we always talk about diversity being everybody's responsibility. So now we have a diversity team that 2 members from each unit within investments, and this was our first project together. So if the members of the team are here, could you please stand up? So it
Everybody
is.
against the back wall.
Yes. So with that, I tell you that we're here to answer any questions you might have on the report.
Thank you, Ms. Brooks. Questions or comments on the report? Mr. Utterman?
Yeah, the report, I think is fine, and no questions on that. I just want to commend you on the effort. It's a very important effort.
Thank you, Tom. Okay. Thank you very much, Ms. Brooks. Thank you for all your service and all the great work that you've done in this area for CalSTRS over the many, many years. Thank you.
Thank you.
The next several items are informational items and first readings. I'd like to remind the committee that if it's the desire of the committee for any one of these readings, if we're comfortable to adopt them as actions, we can do so. If not, they'll come back as second readings. So item number 13, Global Equity Policy Reading, first reading. Mr. Murphy.
Thank you, Mr. Chair. Good afternoon, everybody. David Murphy, Acting Director, Global Equity. To my left, Candace Ronan, Portfolio Manager, Global Equity. This is item 13. This is a Global Equity Policy Revision informational item. And as you know, we tried to summarize this in the executive summary to make it easier for you to review. And really, the majority of the proposed policy modifications center around 2 themes. The first one is allowing flexibility for more internal asset management, and the other one is kind of a reorganization and cleaning up existing language in the policy. So if you could turn to INV 142, I just want to highlight a few of the proposed changes. The first one is investment objectives. We removed a little bit in there that was related to more to the management and oversight and moved that to the appropriate section. And we just updated the objective to be more relevant description. And then we also added a performance objective and a policy benchmark section, because before it was really segregated into U.S., non-U.S. We combined it into a global equity view. But really, the lion's share of the changes is in Section 4, which is the portfolio structure. And again, we removed references of what will be managed internally and externally. And really, the decision for that is covered in Section 6. And if you turn to INV 145, Section 6 is the global equity internal-external management. And it's subsection I. In 2011, the board has approved a decision criteria matrix for determining what would be done internally or externally. And so this is what really drives that decision. So with that, open it up to any questions that you may have.
Questions or comments from Mr. Rosensteel?
Yeah, so I'm having a little hard time following this. Then this is giving giving staff the authority to manage more internally.
That's part of it.
Okay. Where do I see that in the?
If you go back to INV 143, and here's one example. If you go towards the bottom, and it says the U.S. actively managed portfolio is benchmarked to the Russell 3000 ex tobacco and is managed externally. So it explicitly states that it's only external. There may be situations where we have an underweight to a particular segment of the market, and we want to have a passive or a beta exposure to fill that hole. We couldn't do that internally. We'd have to have an outside manager do that. Does that make sense?
Yeah. So this.
So there's a lot of language in here saying that, U.S. passive can be done externally and internally. The U.S. active can be just done externally. And it's just really removing that language.
So it's
within the policy.
allowing there to be more internally
Correct.
actively managed.
Correct. And the active, and I don't want to confuse things here, it could be a fundamental strategy where it's passively managed to a fundamental index, but could be active relative to the overall Russell 3000 benchmark, let's say, for example, in the U.S. equity portfolio.
Well, I want to make clear, David, it is subject to the decision criteria the board adopted on what should be internally versus externally managed. It's not that we can go hog wild and suddenly run, an active mutual fund in-house. We would come back to you every time and say, we now want to run this kind of portfolio or that. The decision criteria was very clear. The more pure active needs to be external. But as David is saying, if we needed to fill a completeness fund, we find out we're not exposed to a sector of the market and we need to run, in essence, an ETF that's a sector fund, we'd come to you and ask, we want to run this portfolio internally so that we can match our benchmark better. So we're asking for that discretion to come to you more frequently with what we should do internal and external, and writing the policies that we have that flexibility so we don't have to come back every time and change the policy. Right. But you've already established a very clear criteria on what we can do internal and external.
And Mr. Rosensteel, I don't know if you had a chance to look at the 2011 internal-external study. They approved Category 1 and Category 2 endeavors. Category 1 was bringing in the entire Russell 3000 index, which is something we've already done. Category 2 was potentially bringing in a fundamental index that's passively managed. Of course, we would thoroughly vet that with PCA, with Chris, with everybody else before we'd move forward and notify you. And then there was Category 3, where before we'd even move forward, we'd come and approach the board and seek permission. And those are more of the active strategies.
So I guess the issue that I have a concern about isn't so much how much is managed internally or externally. It's how much is managed passively versus actively. Because I think we should be heavily weighted on the passive side. And so I don't know whether this is going to be leading to or encouraging more active management. And that, it looked like Alan had something that he might want, David, please go ahead, but.
Direct him, it's INV 143, I'm going to say it's now item 4, portfolio structure. It sets out in policy very clearly that we're 70-30, and the range is plus or minus 10 when it comes to active passive. So that's not changing, that's set.
Is your concern more of bringing active in-house or running just the passive in-house? Because the policy here still has for U.S. management, for the U.S. portfolio, it's 70% passive, 30% will be active.
Yeah, although if you read this, I mean, again, there's a range, right?
Correct.
There's a range
Plus or
of
minus
plus or minus
10%, correct.
And then when you look at non, I think is at non-US, the range is even, I mean, you could very easily, within the existing policy, be running more than 50% active.
Correct.
So, that's what I'm trying to make sure that the purpose of this is more efficient, cost-effective,
And that is-
active management that is geared towards our benchmark as opposed to a change that's going to facilitate and lead to more active management, which.
That is not the case.
Mr. Emkin?
I would argue that all of these strategies are going to be very quantitatively driven, primarily passive internally, which will cause, in my opinion, less risk in terms of what's called tracking error and less fees, and depending on how one defines active management. And then that becomes the question, what is active management? In my opinion, this has the potential to reduce traditional active management.
Great, thank you.
Mr. Moore?
I see that PCA concurred with your proposed revisions. Can you please in the future put all the consultant letters in the material so I can read it and see if there are any comments that I can pick up on for all the policy revisions?
Absolutely.
Thank you.
We'll put that down as a request for information, okay. All right, anything else? Mr. Utterman?
Just a question, and I guess this is a first reading, so they can think about it before we adopt it. As I looked at it and thought about Paul's question, what isn't crystal clear is that as you take additional assets in, it would be passive management, and I guess, and there are gradations of passive between indexing and sort of special. Yeah. So I think if you could make that purpose a little more clear so that it doesn't involve basically starting a hedge fund, that would be of comfort.
Any other questions or comments from the committee? Okay, seeing none, this will come back as a second reading in April. Okay, thank you very much.
Thank you.
Item 14, real estate policy revision, first reading. Mr. DeRay, welcome.
Good afternoon. Pretty straightforward change to the real estate policy. Essentially, we're suggesting to change the benchmark to the benchmark that was approved in 2013 in the investment policy and management plan by this investment committee. So we're just updating the real estate benchmark to match that the Odyssey NACREIF index, which was approved by this committee earlier last year. There's a number of other smaller changes, changing net to gross and changing the numbers so they reflect a net to gross, and just some cleanup items. And with that, I'll open it to questions.
Thank you. Mr. Rosensteel?
So I guess The, the question I have is that we set out at the beginning an expectation to achieve, this is on, right under CalSTRS real estate performance objective on the first page, structure to achieve a long-term total return in excess of the real estate policy benchmark. And then later, though, we have, say on INV 161, there's under core, there's a number 2, target return and benchmark, and the words and benchmark have been deleted. And now we're not talking about a benchmark, we're talking about an expected return in the range of 6 to 8%. So I'm having a hard time understanding whether this is a policy that is supposed to be moving us towards achieving a benchmark or achieving a stated return of, in this case, 6 to 8%.
I think it's this probably had more to do with the structure of the way that real estate is underwritten and the way that policies here and policies that we have reviewed. We do structure the underwritten return to be of to start with the core real estate, which is a stabilized real estate, and we're kind of identifying where this return is. I don't know, Michael, if you had some comment along those lines.
Yes, we did.
Yeah.
And that's been historically in our benchmark to identify the type of return that we're trying to achieve. Although the returns fluctuate with respect to on an annual basis because of appraisal changes, the long-term returns are what's trying to be identified in Section B here. The long-term return from a number standpoint is trying to be reflected in B.
If I can expand on that, if you look at just specifically in the reference section that you referenced, the long-term expected returns for core are 6 to 8% net returns. If you look a little bit further down on that page, under the third to last line where it says the diversification of the real estate portfolio will be compared to the composition of the Odyssey index. And so will the returns. So the index will be Odyssey. The expected return from core on a risk-adjusted basis long-term is that 6 to 8%. And what we're really trying to do here is to make sure that the definition of core is very clear and that the expected returns from core are very clear. So that if you go to invest in something that's got a 10% return and we start calling it core, the board knows it's not core. Because 6 to 8 is really what you can expect in the long term. There might be a reason that a particular core strategy might get to that kind of return, but it's really to give you much more well-defined boxes to define the risks that are assumed in each of those areas. And there's a difference between what's expected for core, value, and high return, and then we have the Odyssey benchmark for your total portfolio, and Odyssey plus a premium for those higher risk categories as well.
So what is Mike and his staff supposed to be aiming for? Are they supposed to be aiming for the benchmark, or are they supposed to be aiming for 6 to 8% return?
Their target is the Odyssey index. That is your benchmark and target return for the objective for the portfolio.
And then the 6 to 8% is just being used
What
as...
core portion should achieve.
But that's not what his staff should be trying to get. They shouldn't be trying to get 6 to 8% on core. They should be trying to meet the Odyssey index, which may be very different from 6 to 8%.
Odyssey is, by and large, a core index. It has about 20% of it can be in non-core investments, but your core portfolio allows for that. It's basically a structure to mirror the Odyssey identically. So theoretically, if you look at the long-term returns that you see here are derived by looking at the Odyssey over a long-term period.
Okay, but I guess that's still what I'm having a hard time. It doesn't mean that every single year Odyssey is going to be somewhere between 6 and 8%,
No.
right? But every year there will be a number that represents the Odyssey index for that year.
Correct.
So is what this is saying is that the real estate group is supposed to on an annual basis meet Odyssey with the expectation that over the long run, that's going to be 6 to 8%? Is that what this is saying?
Yes.
Okay. Maybe we can clarify that, because I didn't quite get that as I read this.
Yeah, I can explain. From a practical matter, when you're purchasing core real estate in the marketplace, it's underwritten to return on an unlevered basis in the neighborhood of 6 to 8%. Over the last 3 years, the Odyssey has returned on an annual basis around 13%. The reason for that is after the crash, real estate was written down significantly and appraised at much lower values. And the cash flow amount that we're getting has been fairly consistent to our underwriting, but the appreciation has been significant. And so that's the difference. We're still underwriting our next deal to get that 6 to 8% return. It might be 4% cash flow from the asset and a 3 to 5% appreciation. But the appreciation has been outstripping the estimates that we're underwriting to. So although we're still trying to beat the Odyssey benchmark, we're not anticipating that real estate would appreciate at those high levels year after year after year. We're looking at a stabilized manner. So when we produce our internal documents for internal approval and they go through the CIO and the DCIO to sign off on, it shows what our and first when it goes through to the consultant as well, we're showing what our underwritten returns are. And it's not compared to the more recent Odyssey returns or compared to our long-term returns of what the Odyssey Index does, which is typically between 6 and 8%. So we want to beat that 13%. We have beat it recently as well the last couple of years. But when you ask what our goal is, we're underwriting to beat typical long-term core returns, and we're pointing out here that's what they are, notwithstanding what the index
Sense.
is.
I mean, what you're explaining makes sense, but I'd like a little clarification, because I got confused between the two in there.
Okay.
Thank
Mike,
you.
is what you're saying is we need to come back to the second reading where it's more clear,
Okay.
Thank you. Right. Thank you.
and we'll do that.
Thank you.
Mr. Hardeman?
Good to know.
My question's answered.
Thank you. Hey, any other questions or comments from committee members? Okay, seeing none, this will come back as a second reading with some clarification in April. Thank you.